All right, folks. Wow, it's great to be back at Consensus. It's nice from this stage because you can really see the floor from back there and all 12,000 people who have showed up today. I heard it was a long wait for some of you to get in today. And for those of you who was a long wait, thanks for sticking to it. There's a lot of RWA talk at Consensus this year. I think we're going to try to add to that dialogue. I guess, personally, I feel like we've waited a long time. Maybe I'd like to start with you, Oli, to talk about a little bit about your business and all these promises of DeFi and RWA and being able to buy a house and it being on chain. Like, how come things are taking so long?
Yeah, awesome. This is great because I'm testing if this actually works because obviously I managed to screw it up as I was walking on. So I think I would call this my third hell loop, sadly. So I started off at JP Morgan running Quorum, which was early days and sort of real-world assets on permission blockchains. Then I went to Goldman to do tokenization there. And I think I'm now trying to make it real for the third time. So I think for me personally, I'd say it's like the technology is now fit for purpose and enterprise grade. Regulations were really not there for most of my time in this space. And then I think business models as well, like we didn't really know where the value was. So hence, I would say now, best time in history to look at real world assets. Hopefully, otherwise I'll be updating my CV again. And I think we're in a good place.
So your business, so you run Venus, right? It's a big lending platform, DeFi lending, but people can borrow and lend right now. Tokenization adds to the list of eligible collateral items, which helps expand this thing, which kind of gives a springboard for people to use DeFi more and more. Is this a need to have, like to have? Like, how important is it to bring in new types of assets in order to make the pool more diverse and to bring in more users?
Well, I think it's really inextricable. On-chain, you gain these inherent properties for tokens that give them these superpowers of being able to interoperate globally at 3 a.m. You can swap, not just for lending, but you can swap USD to securities at 3 a.m. on a Sunday. It's a zero downtime, zero counterparty risk model. It's live and scaling, and there's a long way to go. So even though we're only at nanometers of scale compared to the rest of traditional finance, the growth velocity says there's no slowing down. And we've crossed the Rubicon.
I want to get back on the 3 a.m. topic to you because that was part of our prep call, was about never needing to get sleep again. But Raj, I want to, we talked the last time we were at the Ondo Summit, right, when we chatted, and it was exciting that that Stellar was going to be part of the last mile for some of the probably the most popular RWAs this year, tokenized money market funds and treasury funds. What are your favorite applications that you've been able to get to end users, and what's your biggest hope for the year coming up?
Yeah, thanks so much, Andy. And by the way, speaking of last mile, I want to acknowledge your knee that was surgically repaired. So hopefully you can walk the last mile.
Yes, we're trying to keep my knee a real world asset.
That's right.
Yes.
We talked about RWA meaning real world accidents. So
correct.
Look, so I think the reality of Stellar and what we've really focused on with everything that we're doing is oriented around real usability. So Stellar, when we think about what the purpose of that blockchain is for, is to create equitable access to the financial system. So that's kind of like the through line, but then we also talk about where blockchain meets the real world, and I think many of you have seen the branding all around here. And the ultimate view for me on RWAs is we are looking at projects that people are actually going to use because it's actually solving a problem for them. So when we talk about tokenization, like, you can kind of tokenize anything, but to what end? What is the purpose of doing it? So we were talking a little bit backstage about, we were joking about like Lamborghinis and how, like, yeah, sure, you can put like an asset like that on chain, but is there value to that? Is there a rationale for trading it? Whereas some of the projects that we've seen recently on Stellar that have been really exciting, certainly beyond the money market funds, which we have on there with Franklin Templeton, but it's projects like Etherfuse, which launched basically a stable bond product, and this is called MXNE. And what it does is actually tokenizes CETES, which is actually Mexico's sovereign debt. So imagine that you are somebody in Mexico who has been sitting on the edges of the financial system and hasn't really been able to access a bank account because the banking system is geared towards not fully servicing you based on your job or the amount of assets you have or where you're located. And therefore, you don't have access to yield-bearing instruments that others do, or in fact, have access to safely putting your funds wherever you need to. Now, all of a sudden, there's this asset that Etherfuse has launched that allows you on-chain to go invest in the same type of instrument that is typically reserved for just the highest net worth investors in Mexico. And that's incredibly exciting because it actually empowers people in a way that fundamentally wouldn't be allowed before, but should be what we are focused on when we think about real world utility.
That's amazing. And when we talk about liquidity, I want to get back to that and price discovery. But you know, Mark, you know your customers well. You already are keeping them up 24 hours a day, 7 days a week, trading on Kraken, trading a whole range of tokens, and you're like, you know what, that's not enough. They stopped to eat, they stopped to shower, they took a nap, so we need more stuff for them to trade. What are we going to do? Let's do stocks, right? Was that your thought process, or how can you think, what do you think about adding more assets or more asset classes for your customers to trade on chain?
Look, crypto trading is better than equities trading today. I think that's just true. It's easier to do, more people in the world can access it. The apps are better, the experience are better, they're 24/7, they're highly liquid. Equities trading isn't all of those things yet. Actually, crypto trading is also permissionless, by the way. You can use it on chain, you can use it as collateral, you can move it around between exchanges easily. We don't have that in equities yet. We need it in equities. Tokenization has to come for equities. What has to happen differently, though, from the past, and RWAs to date just really haven't done this. They have to be permissionless. They have to be global. They have to be liquid. I think 2025 is the year a lot of that changes and a lot of that becomes really real. But I don't think we've yet seen that fully work yet. So I'm excited about things to come in 2025. I think this is the year we make crypto and equities and real-world assets and private placements, all these various things, much more interchangeable with each other.
I want to come back to that point. Feel free to jump in if people want to add.
Yeah, so I just wanted to maybe put a slight twist on it. So I think for sure they need to be public, but I actually think there's this idea of public and permissioned as well, because when you think about like, what are we solving for, right? So if you are an asset issuer, you want to make sure like there's some level of control that you have within the system. Like maybe you want it to be an area where anybody can be invited in and all that, but that doesn't mean that you don't want to have core capabilities around privacy, around security, around ensuring that each of those transactions are validated by a core set of constituents that you trust. And I think it's a two-way street here because trust flows in both directions. We talk about trust in a trustless society. Yeah, that's one version of it. But then when you're talking about like a global financial institution, they might not feel exactly the same way. And so how do you meet somewhere in the middle? And so while I do think like the kind of ethos of blockchain is like public permissionless, I think that there's a reality which is that having a permission nature to the blockchain actually adds an incredible amount of value as well. And so I think that might be where we end up landing.
I've got to think that's a better thread than where I was going to go. You must have something to add to that, Oli.
Yeah, I think I actually agree with both of you. I think you know where I think you want to have public networks that anyone can join, and then you want incremental KYC on top of that, based on at the app level. And I think in terms of bringing it back to sort of my view is, you want to deliver for certain audiences like a unified Web 2 experience, which obviously you can provide given crypto trading and equities. I think even with other industries, like I'm looking to disrupt the real estate market, you can basically rip out the back end of these incumbent legacy industries and replace them with blockchains that are public with the right permissioning and privacy, and then obviously the performance layer. And I think for me, it's more about collapsing value chains. Like I get more interested about global settlement layer, where you can merge money, assets, and data onto one software platform. And that to me is where you unlock a huge amount of innovation, because then you can take these legacy, old-fashioned industries and make them 24/7 global composable and smart. I don't necessarily think, like you said, tokenization to me in and of itself is like tokenization to nowhere. And tokenization does not equals liquidity. But if you're embedding it in a smart way into existing legacy value chains, and when you're collapsing those value chains, then I think you get some really cool, you can unlock a whole new generation of businesses that are going to be built on top of blockchains.
Fantastic. Did you want to hop in, or are you good?
No, let's move on.
Let's move on. Liquidity, right? At the one end of the spectrum, you have something which is on the blockchain. Everybody can see it. Everybody knows who owns it. On the other end, you have something for which price discovery is easy because it's trading in 75 places and you know its valuation instantly. It's hard to trade this. It's easy to trade that. The more RWA, the more tokenized things you have, right? The more things you have to maintain liquidity for those you need. This is not free, right? This comes naturally, at least at the beginning, as a cost. For example, when you think about having new assets come on, price discovery and tradability is kind of inherent, right? Does that limit you, or how do you think about funding price discovery and liquidity?
Yeah, liquidity isn't free unless you're the Federal Reserve, right? And then you can print all liquidity
you know
want.
exactly how much it costs, right?
But centralized exchanges emerged as the primary venue in crypto because they were the on-ramps, and they had to source liquidity. They use maker rebates, and it's been an effective model. In DeFi, there's also a really robust incentivization model where you're stacking your yields. So the hedging costs are lower, you have token emissions, you have native yields, you can combine these. And there's also these other properties of doing yield strategies on chain where as on a centralized exchange, you can repurpose inventory, and then you can collateralize, but on chain, you can do both. So composability is really the silver bullet of doing strategies on chain, which is why eventually it's all going to shift on chain. Everything that we're doing now, DeFi will be the default backbone for all of finance. Composability is really about bringing it all together and making it more automated and efficient.
I love that. Mark, do you worry about if you have your listing 500 equities that just some of them won't have even the right price discovery, much less depth, or you're adding a lot of assets and you're trading 24/7?
I'm not worried about it for equities to a large extent. I think actually of all the real world assets we're talking about listing over time and tokenizing over time, I think it's actually the easiest space with the most liquidity that can be imported into it. I agree. I think there are DeFi mechanisms that create the right incentives to create liquidity as well. And that's actually what gets exciting about bringing these types of assets into DeFi, is I think they actually are mechanisms to create liquidity without the same need for centralized market makers in the middle. As we start to move to other types of assets, real estate and other components, I do start to worry about it, and I start to wonder whether the gap is actually sufficient interest to create liquidity versus actually the technical reasons why we don't do it. And I think that's something that'll have to be proven out over time.
Oli, do you see a mechanism by which, I guess some of the things that you're tokenizing, it's helpful to have a valuation at least once a year for taxes, right? Yeah. So is that going to be handled traditionally, or are there technology solutions or on-chain solutions for that?
Yeah, I think my view is I think that these worlds are all going to coexist and blur together depending on the use case. So I think if you're a typical retail user of Kraken, you're already buying crypto, you want to buy equities, that really you're competing with Robinhood, and everyone's collapsing all the centralized exchanges, and I think that totally makes sense. I just want one single place for my Web 2 experience, whether I'm buying crypto or any other asset class. I think on the DeFi side, I do agree. I think where it gets really interesting is everything is infinitely composable, and you can mint any investment exposure on any asset, whether it's crypto or a real-world asset, into an unlimited set of tokens. And I think that's where I feel the world is going. And it just depends, like, how are you going to access it? If you're crypto native, you might go through your own self-hosted wallet. If you want to go into a centralized version, you'll go into a centralized version. But I do think the benefits are yeah, real-time price, composability, and making things programmable. And for me, it's more, like I was saying before, you really disintermediate all the old-fashioned traditional payment rails around nation-state payment rails, global payment rails, and you're merging those three layers into one. And I think that's where you get the magic. You don't need to trade real estate every day. If you want to, you could. But it's more about, I don't need to interface with ACH, SWIFT, you name it.
I just can't wait for the securitized mortgage pools, and we can have a margin call viewing party and just start the whole machine again, right?
My view is
liar's poker, everything.
It will be transparent, or it'll be verifiable if you're permissioned, and you won't be able to have the repeat of 2008 because I spent years partnering with like mortgage traders at both JP and Goldman. They use CSV files to manage all their mortgage-backed securities. That will all be digital and linked to the assets. So I actually think my view is you're going to reduce risk. There'll be more transparency for those that need it, and you can have the democratization. And I think that's a key thing. Like to do a mortgage-backed security now, only JP Goldman can do that, and I think you can bring that down and open it up to individuals.
So robustness and, Raj, I want to ask you about incentives and tokenization quality. I think if everything goes to DeFi, great, easy, write some software, things can happen pretty quickly. It feels like for some use cases, handheld tokenization with issuers and trust are going to be necessary, but that's not free either. That and liquidity costs something. How is that paid for, and how are the tokenizing agents going to receive the scale of something that gets popular?
Yeah. Well, I want to talk, well, two things. One,
hit another thing first.
When you started talking about mortgage-backed securities, I had like a terrible flashback to the work that I did in traditional banks during the early 2000s, and that was rough and a little icky. The interesting thing about liquidity, I think from our perspective, and like what we get to see, because as a blockchain, we get to see a lot of different asset types, and we have a lot of conversations with people talking about tokenizing things. But liquidity doesn't just happen out of thin air just because you've tokenized it. There has to be an inherent liquidity to the product itself. Now, it may not be available. So let's talk about like real estate, for example. Real estate has generally been illiquid, but it's because the price to entry is high. But the reality of why it's valuable is that the yield can be really strong. There's ample opportunity for it. It may generally be considered safer. And so when we talk about like incentive structures, I think the incentive structure is very much tied to like what is happening. Private credit, I think, is another example of something that I'm very excited for that generally wouldn't have had liquidity but for being put on chain. Now you have it, and it has an inherent desire to do it. Obviously, like money market funds have done really well. Franklin Templeton issued their FOBXX money market fund natively on Stellar, using the Benji token, and it was, I think, a real success story. I think we all relatively recognize what that's been. But the interesting thing about what that looks like is that the incentive structures become aligned to what the capabilities are. So what happened with the money market fund? Well, so the average cost of entry to a money market fund used to be like $2,500 or $3,000. Now, tokenized on Stellar, the cost of entry is $25. So now you've created liquidity because you've actually created greater access. You've also created efficiency for somebody who's actually launching it, because no longer are the days of like having to deal with like all the back office stuff or the reconciliation on spreadsheets or all of that. So there's like a human capital cost to it. And that's where the incentive redeployment, I think, becomes really effective, because now you've attached it to a greater market. And that doesn't mean the traditional market doesn't exist, right? You can still go invest in a money market fund through whatever asset management capabilities you have. And now you also have this as well. And so augmenting these things together, I think, creates this incremental pool of value, because you're no longer having to deploy it against intermediaries. And that's where I think you get the real value deployment.
And will that be a good business to get in? Like, I guess there are fees charged at the fund level for the portfolio manager services. That's normal. But then the transmission of that onto chain was a funded experiment, right? So at some point, is that going to be a great business? Is that going to be a utility business? Are you willing to share profits from the lending pool with people who furnish more assets into the pool, or like how do people get paid?
It already works that way, and one of the differentiators of Venus is that we're doing that to a higher increment than other lending protocols. So you have to, the key is giving the value back to the participants, back to the counterparties, instead of putting it into a black box for banker bonuses, right? So there's just more value extraction, and that's part of the model. But the exciting thing is that money market funds were just the beginning. They provided a safe sandbox for us to prove out the tech and support custody rails and bring liquidity that treasurers could feel safe with sourcing on chain, and that's going to bring billions in borrowing for the next wave of assets that are coming. So there's this flywheel of collateral and credit that's going to be expanding. Money starts with money market funds, but a lot more asset classes are coming down the road, and they're all going to be able to participate in this value extraction through the lending protocol.
I love it.
Look, maybe I'm being a bit controversial on this one, but
let's go.
Let's
end on a violent note.
Money market funds, where one of the big use cases is that you can enter with $2,500 instead of, with $25 instead of $2,500. Not that exciting. Probably could have been done in traditional spaces, except banks are somewhat inefficient, but they could be more efficient to solve that problem. And then, oh, by the way, actually, you and I can't trade the thing. We actually have to go back to the issuer and trade it back with them in almost all cases. I hope that's not the future of RWAs. If it is, I think we're still going to be on this stage talking about its potential 5 years from now. I don't think it is. I actually think regulators are starting to get their heads around what it's going to take to get there, which is really exciting. But it's going to take something significantly bigger than what we've seen today to make this something that will reach the potential that I think all of us are excited about.
We have 1 minute left. I want to do, this time last year, we didn't have Bitcoin ETF options. We just had ETFs, basically. A year, amazing things can happen in a year. So 1 year for Consensus, back in Miami next year, next May. What do we hope is advanced in each of your businesses? Can you start, or do you want to go last?
Well, I'll say that likely it'll be collateralizing any RWA in a lending protocol, from money market funds to private credit. We already have 24 billion in private credit tokens on chain, and we hope that the next ones will be real estate or any derivative or financial instrument that Wall Street is accustomed to trading with in the off-chain world next year.
That's a lot for a year. Your engineers, are they listening to this?
We're in the middle of the original financial engineering renaissance, so this is the time to get it done.
Fantastic. Oli.
I guess for me, I'm 4 months out of TradFi recovering, so I would say in a year's time...
You're still detoxing.
I'm still detoxing, so I would say I finished the detox. I'm live in production. We've got actual use cases, utility, and we're scaling quickly. And then the assets are composable and as collateral on your platform. That's the future.
Fantastic. Mark, 12 months from now, Consensus 2026?
I look forward to a world where tokenized assets, real-world assets, and crypto assets don't look very different from each other. And I'm holding both of them in my wallet and trading them on-chain.
Fantastic. Raja, final words.
Yeah, I mean, I think I agree with what everyone said. I would just say, yield-bearing RWAs, I think, are the key. Those are the ones that you can put in the DeFi protocols. Those actually generate more value, and that more value is, I think, actually what moves the needle, and that's where we'll create the inflection point. And then I would just, make one more plug, which is once you have that, the usability, the on-ramping, the off-ramping, all of those things that actually allow you then to participate with that asset into all the rest of your life, your financial life, I think is critically important, and we're going to see a lot more of that, I hope.
Fantastic. Great. I loved it, guys. Thanks so much. Thanks, everybody, for sticking around.